Imagine the feeling of looking at your bank account and finally seeing a comfortable cushion. You did it. You stopped living paycheck to paycheck, you cut back on unnecessary expenses, and you successfully built a safety net. You should feel entirely at peace. But then a few weeks or months pass, and a strange, new kind of anxiety starts to creep in. You look at that balance, and instead of feeling secure, you start to feel like you're losing ground. You read headlines about inflation eroding the value of cash. You hear stories about the stock market hitting new highs, and suddenly your safe haven starts to feel like a leaking bucket. This is the saver's trap. It's a very real psychological crossroads where the exact habits that saved you from financial disaster start holding you back from building actual wealth. You see, you've spent a massive amount of mental energy training your brain to do one specific thing: hold on to cash. To your survival brain, cash equals safety. So when someone tells you to take that hard-earned safety and put it into a volatile market where numbers fluctuate every single day, your instincts scream at you to protect what you have. There's a profound biological reason for this hesitation. Psychologists refer to it as loss aversion. Studies consistently show that the psychological pain of losing a dollar is twice as powerful as the pleasure of gaining a dollar. When you transition from saving to investing, your brain doesn't immediately see the potential for future growth. It sees an immediate threat to your survival. It looks at a fluctuating chart and triggers the exact same stress response as a physical danger. To break out of this loop, you can't just rely on willpower or tell yourself to stop being afraid. You need a systematic, step-by-step path that allows your psychology to catch up with your financial goals. You have to learn how to transition from a defense-only mindset to an offense mindset without triggering your brain's alarm systems. The very first step on this path has nothing to do with buying stocks or choosing funds. It is about drawing a hard, psychological line in the sand between your survival money and your growth money. The biggest mistake people make is looking at their entire pool of savings as one big number and trying to invest a chunk of it. This instantly triggers panic because you feel like you are risking your security blanket. Instead, you need to create a structural boundary. Your emergency fund must be kept completely separate from any money you intend to invest. This money isn't meant to grow. Its sole purpose is to provide psychological protection. It sits in a boring, high-yield savings account where it behaves exactly like cash should: stable, predictable, and fully accessible. Once your brain knows that your baseline survival is fully taken care of and insulated from the stock market, the remaining capital changes identity. It is no longer survival money. It becomes leverage money. Once you've established that boundary, you enter the second phase, which is all about desensitizing your brain to market volatility. You don't jump from a savings account straight into investing thousands of dollars. That's the equivalent of jumping into the deep end of the ocean before learning how to float. You will panic, pull all your money out at the worst possible time, and swear off investing forever. Instead, you start the $5 experiment. The goal here isn't to make money, it's to experience a loss that doesn't matter. You take an amount of money so incredibly small that if it completely vanished tomorrow, your daily life wouldn't change in the slightest. You open an investment account, put that tiny amount into a broad market index fund, and you intentionally watch it move. Over the next few weeks, you'll see that $5 turn into $4.80 and then up to $5.20. Your brain gets to witness the flashing red colors of a market dip, but it also realizes that the roof didn't cave in, your utilities are still on, and you are perfectly safe. You are training your nervous system to accept variance. You are breaking the fear barrier by showing your brain that market movement is not a catastrophe. It's just a natural breathing pattern of the global economy. Once the fear barrier is broken, you can move to the third step, which is shifting your identity from a collector of currency to an owner of assets. When you are strictly a saver, you view money as a finite resource that disappears the moment you part with it. Every dollar spent is a dollar gone. But when you become an investor, you realize that you aren't spending money, you're exchanging a depreciating currency for an income-producing asset. Think about it this way. Cash is like keeping water in a bucket. It's useful to have nearby if there's a fire, but over time, that water slowly evaporates due to inflation. Investing is taking a portion of that water and using it to plant a seed. When you buy a broad market index fund, you aren't gambling on a single company or trying to guess the next big trend. You are buying a microscopic piece of thousands of the most profitable corporations on Earth. You become an owner of the companies that make the technology people use every day, the energy that powers our cities, and the logistics systems that move global goods. You are shifting your position in the economic ecosystem from someone who merely consumes things to someone who owns the infrastructure producing them. This brings us to the fourth step, which is the most critical component of the entire path: building an invisible automated engine. The absolute killer of investment returns isn't market crashes, it's human emotion. If you have to make a conscious decision every single month to transfer money from your checking account into the stock market, you will eventually talk yourself out of it. You will look at the news, see a scary headline, and decide to wait until things settle down. Or you'll see the market hitting record highs and think you missed the boat. The most successful investors remove their own decision-making process entirely. You set up an automatic transfer that aligns perfectly with your pay schedule. The day your income hits your bank account, a predetermined percentage is automatically swept into your investment account and deployed immediately before you ever have a chance to see it, touch it, or spend it. This strategy completely flips the psychology of a market downturn. When you automate your investments, you are buying a fixed dollar amount of assets every month. When the market drops, your automated transfer doesn't stop. It simply buys more shares at a lower price. Suddenly, a market correction isn't a stressful event that makes you want to hide under the covers. It becomes a period where your automated engine is quietly buying assets on sale. You stop rooting for a volatile world to stay perfectly still, and you start benefiting from its natural cycles. The fifth and final step on this path is learning to embrace the sheer boredom of wealth creation. Pop culture has painted investing as this high-adrenaline, fast-paced world of trading screens, constant monitoring, and massive overnight wins. But the reality is that truly effective investing is incredibly unexciting. It feels like watching grass grow or paint dry. The magic happens quietly in the background through the compounding effect. In the first year or two, the progress will feel agonizingly slow. You might look at your portfolio and realize that your actual gains are tiny compared to the amount of money you've personally contributed. This is the valley of disappointment, where many people give up because they don't see immediate gratification. But if you maintain the system, the math eventually takes over from your effort. Over a long enough horizon, the returns generated by your investments begin to make more money than you were contributing out of your own paycheck. Your assets start doing the heavy lifting for you. The ultimate transformation that occurs along this journey isn't just the growth of your net worth, it's a complete evolution of your mental bandwidth. When you are stuck in the saver's mindset, your focus is entirely trapped by the present moment, how to protect what you have right now. But as you progress along the path of investing, your perspective stretches across decades. You stop reacting to the daily noise of the world and start participating in its long-term growth. You transition from a state of preservation to a state of creation, and that is where true financial freedom begins.